Hello and welcome to the Mutual Fund Show. I'm Niraj Shah, and it's something that a lot of people always look out for at the start of the year, uh, at the start of the last quarter, that is, which is tax-saving mutual funds. Now, I know most of us try to think about it only in the month of March, but I think the good part is that our HR departments start asking for the tax-saving proofs in the first 2 weeks of January, and this is when, therefore, having the idea of which mutual funds to invest in on the tax saving side becomes very important. So we've been doing this now for 2 years with Kaustubh Belapurkar, wherein we get him at the start of the year or the start of the last quarter to ask him about which are the fund options that are the best and what should one keep in mind when investing in tax saving funds. And he joins us again to talk about the same. A whole host of you would be watching this for the first time, and I hope this is beneficial for you. Kaustubh, really good having you. Thanks so much for joining in. Wishing you a happy 2021.
Hi, Niraj. Thanks for having me and Happy New Year to all the viewers.
Yeah. So, Kaustubh, tell us before we get down to specific funds and why do you like them, etc. Um, one question on what should people keep in mind? The few things that people should keep in mind while investing in tax saving funds.
Sure. So I think you really set the context, Niraj, that typically, and I think it's human nature, right, to kind of scramble around at the last minute when you get in. So I think obviously one of the things that we talk about tax saving ELSS or tax saving mutual funds are a great way of doing that. There are a couple of things you need to keep in mind. One is obviously given that equity is a long-term investing asset class. And the way the funds are structured, we would recommend, while the lock-in's only for 3 years, we would recommend coming in with at least a 5-year investment horizon, if not more, because we know markets can be volatile. And in times such as these, when markets are trading at sort of new highs, it's very important to have the right sort of investment horizon in mind. So I think that's of paramount importance that you think about what really is your investing horizon of the money that you're putting aside to save tax, because the last thing you want that you come into the shorter time horizon, markets are flat, they're negative, and you actually need to exit your investment at a loss or maybe at a flattish. Perhaps then maybe a different sort of tax saving investment is a better one with a more fixed sort of return profile. So I think that's a very important thing to keep in mind before we delve upon talking about what ELSS funds we like and in general. And obviously if you have the time, you can actually start staggering your investments from the start of the financial year rather than kind of putting it right towards lumpy towards the end of the year, because March, April of 2020, actually April of 2020 would have been a great time to make your investments for the financial year. So I think that's really something that sort of broad pointers that you would keep in mind when you're making these investments.
Cost of the other point being that people should kind of let me ask you this way, that for example me, right, I have my EPF contributions that go out.
Right.
I also have been doing some bit of PPF, though I've kind of scaled it down over the years. But let's assume that I also have some PPF. So therefore, when I'm investing within that ETC amount for tax saving funds, would you reckon that I should do those investments only to the tune of 1,50,000 minus the amounts that are going in already? Or would you believe that the entire 150 is good to do because tax saving mutual funds anyways are a good option? How do you approach it?
So I think there are a couple of questions that each investor would need to sort of question. So obviously, you have components that would anyways be kind of be it your EPF or if you're making any other investment. But I think what's important is I touched upon it, that when you look at it from the perspective of your overall portfolio asset, sort of, are you looking for an equity exposure? Are you looking for a more fixed exposure depending on your risk profile or investment horizon? I think that's important. For more aggressive, longer term investors, you could potentially look at putting the entire amount in, the 1.5 lakhs if you don't have. I mean, obviously you have a PF contribution, but whatever difference that's there can easily go into an ELSS. But someone who's got a shorter time horizon doesn't want to take on excessive amount of risk. Maybe you want to do a more pragmatic approach by putting a smaller amount and also allocating to some of the other options that are available, be it a PPF or some of the other sort of more fixed interest options that are available within the portfolio for ATC savings. Obviously, the other sort of element that comes in now with the old and the new tax regime, it's only relevant if you're in the old tax regime. But the broader thing is also that we think about that in ELSS fund, while it comes with an enforced 3-year lock-in, it's actually a great investment product just to start with. And one of the things that we talk about is that while investors will feel, hey, why do I lock in my money for 3 years? But 3 years is actually very little time when you look at an equity investment, right? So in a way, if I'm a new investor, I wouldn't mind actually telling a new investor invest in ELSS purely because that sort of discipline. Mentally, the investor can't redeem in the next 3 years. So, that financial discipline comes in that they stay invested despite, say, for if the market crashes or whatever, the case may be. I think that kind of also brings an element of financial discipline with especially the newer, less savvier investors. This can be a great tool to kind of use, not just for tax saving, but even for kind of mentally attuning investors to stay invested in the markets.
Okay. And the other question is, should one before we get down to individual funds, should one bother about the size of the fund, fund manager characteristics, as well as the house? Do the normal rules for mutual fund selection apply to tax saving funds as well?
So I would definitely think that yes, you have to be prudent about the fund you're selecting, and size may not necessarily be I mean, it could be a criteria thinking about if you want to do some filtering on the funds, but it's not something that can make or break. And I'll kind of talk about that when we talk about the various funds that we like. That's not because when you look at the construct of the ELSS funds within the Indian mutual fund space, they're still predominantly large cap bias funds. So I don't think there is a size constraint per se in terms of a very large fund being difficult to manage. I think what's important is to understand the philosophy, the investing philosophy of the fund, and have they really stuck their guns out even through trying times? Because when things are good for you, your style is working, that's great. But even within trying times, have you really stuck to your investment mandate, your core investing philosophy? I think that's really the test. A testament to that. There's a great process in play for that fund manager or for that fund. And also, you need to look at that fund from the fitment of your overall portfolio. And we talk about styles. I think that's very crucial, and maybe it'll be best addressed through when I talk about some of these specific examples of funds that we like. We can really make that relatable as to what that style is and how does that fit in a portfolio.
Okay, so let's start with that. Let's start with. I mean, are you going to speak about them in the pecking order of preference, or is this in a random order?
No, this is completely in a random order. To be honest.
Let's start with one. Let's start with the first one.
Sure. So let me actually start with the ones which are more popular right now, and because they're funds that have been doing really well. So there's one fund that we've liked for a very long time, which is the Axis Long-Term Equity. It is, in fact, we spoke about size. It is the largest sort of ELSS fund that's being managed in the industry right now. But there are a couple of things that very crucial to keep in mind when you think about this fund, right? So when you think about the philosophy, we spoke about the style and the philosophy, and Janesh, who manages the fund. Clearly, the entire Axis sort of philosophy or the ethos is looking at companies that are sort of growth sort of stocks, investing in high growth stocks, and they don't really worry too much about valuations because they believe that as long as the growth rates of the stock can justify the valuations, even though the valuations have sort of gone up, they're happy investing in it for the long term. And this is something they've applied for a fairly long period of time. So it's not like something that they started adopting only 2-3 years back. They've been doing this as a asset manager for ever since pretty much since inception, right? And just to kind of make it relatable, because this fund's been doing really well over the last 2 to 3 years. But if I just dial back time to 2016 and 17, the fund went through a trough. And what's important to understand is what happened and what did the manager do, right? So we spoke about the fund manager's style, growth, and he doesn't mind paying a premium for that growth. So if you saw the stocks on the screen that he's currently holding, the likes of Bajaj Finance, he's obviously overweight in stocks like HDFC Bank. He's got a lot of financials, consumer cyclicals, some of the consumer defensive. So he's got stocks like Avenue Supermarts. Some of these stocks that we identify as expensive but high growth stocks, right? Now this is this style he's been applying since even, like I said, for a very long time. So 2016 and 17 was a market cycle that really favored some more of the cyclicals, sort of metal stocks and some of those, which Janesh as a philosophy completely avoids. So it didn't work for him in 2016, 17, but he stuck his guns. And the proof of the pudding is that when the market cycle turned in favor of his style, we've spoken about how it's been a polarized market towards the high quality, high growth companies for the last couple of years. It's really paid off for him. But the important point is that stuck to his guns. He didn't waver because the market cycle wasn't in his favor, 4 or 5 years back. So I think, that philosophy, sticking to that, has really paid rich dividends, and that's a fund that we like. Just a word of caution, obviously, that we've seen a lot of money come in into this fund over the recent past, given the supernormal returns that some of these funds have delivered more recently as compared to the peer group. I think that's something that we just want to advise investors that market cycles can turn. The fund could again potentially go through a trough on a peer relative basis because the market cycle turns towards probably more value or the cyclical names. But the point is, over a market cycle, you should do really well holding on to this philosophy because the manager is not going to change, the way he manages the fund. So I think that's very important.
Mm. The other one is also something, a house from which a lot of funds have done really well, Kaustubh, and that's
Right.
Mirae, right? The funds have caught the fancy of people. Why do you like the Mirae Tax Saver Fund?
Right. So Mirae is another fund. I think we spoke about Axis being sort of growth, not really being too perturbed by valuation. I think the Mirae probably dials it back a bit when we look at the Mirae Tax Saver Fund. Another, so again, Nilesh, who manages the fund, Nilesh Surana, great manager. Obviously he's managed funds with Mirae for a fairly long track record with a lot of success, right? But when you look at his style, he's more what we would call, I mean, he's largely predominantly a growth manager, but he also looks in building in that sort of margin of safety into his purchase price, because he's looking at what the intrinsic value of the stock is and can he get it at a sort of margin of safety discount when he's buying the purchases. That means that he would probably take back his exposures in stocks when the valuations become a little too excessive when they've run ahead, and probably buy them back when they become a little cheaper from that relative context. So he's more of a growth at a reasonable price manager, and that shows up in the way he manages his portfolio. He would also buy what we would call, sort of with a value tilt to a certain part of the portfolio, not a very large component, but he would definitely kind of take some bets in that. I think classic case when we've been speaking in relation is that they did move into healthcare, more than a year and a half back, seeing that obviously valuations were very compelling. There were some good companies to buy, and that's obviously paid rich dividends to them, in the year of 2020. So I think overall a solid process. He's looking into that sort of portfolio of buying a slightly more diversified portfolio. Axis was a slightly more concentrated portfolio. Nilesh should typically build a 50-60 stock portfolio. But also be a little more conscious about valuations and trim positions if required. At the same time, also take in some value positions where they see that fundamentally nothing's wrong with the stock, but they've been beaten down for other reasons. So I think overall, again, this has been very, very beautifully applied, the process, and obviously the proof of the pudding is that the fund's done really well across market cycles.
Yeah, well, and again, so is the word of caution also there that because it's done so well that there could be some underperformance going ahead?
Absolutely. I mean, that would actually, that would be like a common theme, I think, for all funds. I mean, irrespective of, because what happens, and we've observed, right, that the most common metric that people would be happy to look at is the most recent performance of the fund. Now, that's great. For us, it's an important thing to look at because it's a proof of the pudding that is that style, or, is the process working for the manager or not. But that shouldn't be the only criteria. You should understand or try to deconstruct where the performance has come from, and also be acknowledging the fact that their market cycles will change. I mean, we've seen over the last 2-3 months suddenly there's been this slightly short term, but we've seen this more value sort of beaten down stocks kind of starting to pick up. It's also been the case for the first 2 weeks of the year. Still very early days, but neither you, me, or any fund manager can really predict when that market cycle is going to turn. But there could be periods where a particular style can underperform, and that's why we always think about when you pick a fund, try to think of it from the context of a portfolio. If you have all growth style funds in your portfolio, you're probably better off picking a more value tilt fund because it'll really diversify your portfolio beautifully rather than really be concentrated towards a particular style, because could do well over a period and suddenly you would have a major lull period where all your funds are in a similar boat. Rather, you would have funds with different styles, which could be an all-weather portfolio, as we call it.
Also, the third one is DSP Tax Saver. Now, why do you like this fund? And part two of my question is, Their CEO is a really smart fellow, right? Kalpen has really institutionalized the processes, etc. So he's kind of done some amazing work on that front. On the fund management side, they've had a few exits. Maybe not for this fund individually, but at a senior level. Anup went away some couple of years back. Bhalat joined, he had left, etc., etc. So is that a worry at all, or there are processes in place enough to see it through?
Sure. So maybe I'll actually address the second part of your question to lay the context for why we like the fund, right? So you're right. They've obviously seen some. Anup was an integral cog of the wheel for DSP, and then he kind of moved on. But I think what's important to acknowledge is that one was when they were working with BlackRock, they really set in place a lot of investment processes, and they've only kind of fine tuned them, be it on risk management, the overall investing framework. They've really ironed those out, over the years really well, and they've only fine tuned it even since sort of BlackRock moved on from sort of the joint venture with GSP. That said, the other thing is also very important to understand that people like Rohit, who manages this fund, he grew as an analyst within the team and then took on fund management responsibility slowly and has really kind of come up the curve. Then you have obviously Vineet, who's more of their mid and small cap specialist. And a lot of their team, the rest of the teams really stayed stable over time. So one is obviously the great processes. A lot of people with vintage of the GSP BlackRock days still within the system gives them an immense amount of comfort that the processes again are pretty rock solid, and you would see that kind of across their strategies. I think that's very important to acknowledge. When I think about Rohit as a fund manager, I think he's a little more fluid in his investing thought process. He will obviously, again, he's got a large cap bias, but he will look to maybe even trade in and out a little bit of his. I don't think he's doing excessive trading, but you would see that his portfolio would have a little more churn than some of his peers. The mid-cap portion of his portfolio is obviously buy and hold, remain steady, and that's where I think DSP is one of amongst the better teams in identifying the mid and small cap stocks, which is great plus. But on the large cap side, again, he would kind of do a little bit of counter cyclical plays, trade in and out when valuations become excessive on certain counters. And overall kind of, not really worry too much about what the benchmark holdings are or what the sector weightage is. He can move a little fluidly between that. And that's his style. And he's applied that, pretty well over a period of time. And that's why you would see that, some of his top holdings, obviously some of the favorites, but you'd see like a name like a Bharti Airtel that comes in, an ICICI Bank, which is another favorite, but, probably relative to an HDFC Bank, has got a higher weightage amongst that. So I think broadly a great investment process, but he's more, I would say, in the middle. He's looking to obviously buy growth, but he also looks at some value, investments that he does. So again, when I just, and that's why I started in this particular style, that I spoke about a pure growth manager, which is Axis. Then I moved to a more sort of growth at reasonable price, Nilesh, and then moving down the spectrum away from growth stocks to more blend and value, which is Rohit, and then that'll lead us to our fourth sort of manager within that.
Got it. The last one is interesting. Franklin. Why Franklin?
Yes. Yeah. So again, if I just think about the style of the fund and the way it's been managed, right? So Lakshmikant, took over the reins about 4.5 years back. Now he runs a pretty counter-cyclical sort of strategy. He's got a much greater sort of core and value blend within his portfolio. And if you look at the most recent track record of the returns of the fund, you probably won't want to pick the fund because you would think that, hey, this fund's not done well, right? But there's a reason for it because of his investing style. And like we spoke about earlier, it's been in favor of growth. And obviously, given where he's been applying his portfolio, in fact, if you look at his most recent positions, he's got overweight sectors like utilities, consumer cyclicals, which are kind of now making a comeback. So he's taken that sort of approach. It's not necessarily paid off in the recent time because the market cycle wasn't in his favor, but that's the beauty, right? I mean, you try to pick managers, but I said about different styles. Even within sort of his banking exposure, when you look at it, he's got some of the more corporate banking names, likes of Axis being his top holding. So I think it's a slightly differentiated portfolio as compared to the others. The other thing Lakshmi does really well is that he's pretty agnostic to, in terms of he does take some bold sector calls. Utilities, in fact, like I said, is a pretty, so it is a slightly more, sort of away from a benchmark sort of strategy. But I think it's an interesting play for someone who's got, a large component in sort of the growth stock or the growth spectrum of his portfolio. They can definitely look at adding something, fund like this in the portfolio.
Okay. And would you reckon that, last question on the show, would you reckon that people rather start off their tax saving SIPs from April itself, or is it okay to do it in the months of Jan, Feb, and March?
Ideally, discipline would be great. Like, we talk about doing SIPs as a regular investment in other equity funds. I would say, why not in tax funds, right? I wish I had done some of my investing back in April if I had the liquidity. I'd be smiling a lot more. But we can't time the market, obviously, but to take away that human emotion, why put yourself at a risk while it might not be a very large proportion of your portfolio, but it's just nice to have that discipline so that you're not scrambling at the last moment to find a fund or make that investment. Just stagger it out, just set an SIP in process. You can just pick one or two funds and just keep at it. Or even one fund's good enough, right? So that discipline is always good to have. Most of us don't end up doing it, but it'd be nice for all of us to practice that.
Okay, I hope people are listening into that. But Kaustubh, take a moment to thank you for joining in today and giving us your thoughts on which are the best tax saving funds. Really appreciate your time.
My pleasure, Niraj. Thanks for your time.
Thank you, and wishing you and all you viewers from a tax saving perspective a happy quarter. And maybe, just maybe, viewers, if you are starting off now, better to start off now than the month of March, but better to do it start of the year from April. Small amount every month, which adds up to the amount that you need to put up for every year, as opposed to doing it starting Jan, February. Thanks so much for tuning into the Mutual Fund.